try to do a bigger distribution in advertising this one. So we hope for those of you that are new, you'll enjoy this and give us feedback. By all means, all of us like to hear back from you and tell us what we can do better. My name is John Kruse. I'm going to give you a part of the program, but we've got a lot of other much more talented people than me that are going to be talking to you today, and they're going to be giving you lots of different types of insights about what's happening out there. Our agenda, Peter's going to take us through a little bit of a CFAP overview again, in case you haven't heard a lot of the details about that. I'm going to touch just basically on some other topics from a broad perspective. And then Marty's going to take us through the corn outlook. We'll talk a little bit about the soybean outlook, and then Wesley's going to talk about the livestock outlook. And we don't want to take too much time with the others because we have to give Wesley more time this time. Otherwise, he'll get me. So later on, we'll take some questions. I hope that you'll keep those in your keep track of those as you go. You can certainly send them through the Zoom and ask questions directly that way, or you can ask on the phone at the end of this. So without further ado, I'm going to jump directly into special topics and hand it over to Peter.
All right, John, I appreciate it. John asked me just to do a little bit here. I'm not going to spend a lot of time on particulars. I think everybody, especially on this call, probably knows a lot about CFAP, but the Coronavirus Food Assistance Program was designed to provide direct support to ag producers who face price declines and additional marketing costs due to COVID-19. And commodities that are eligible, or producers that produce these commodities, suffered a 5% or greater price decline or had losses due to market supply chain disruptions due to COVID-19 and face additional significant market costs. Sign-ups currently underway. Deadline is August 28th. I know the county offices are kind of swamped with this, and I'll talk about that a little bit more in a couple of slides, but I do encourage people to get their producers to go ahead and get this process started. There's 2 tranches of payments, an initial payment of 80% to be issued after completing the sign up, and then a final payment, the remaining 20% will be issued at a later date if funds are available. It's not moving the slide for me, John. There we go. Okay, commodities that are eligible include non-specialty crops, malting barley, canola, corn, upland cotton, millet, oats, soybeans, sorghum, sunflowers, durum wheat, and hard red winter wheat, wool. On the livestock side, cattle and hogs, and sheep is just lambs and yearlings only. Dairy, specialty crops, fruits, including apples, avocados, blueberries, cantaloupe, grapefruit, kiwi fruit, lemons, oranges, papaya, peaches, pears, raspberries, strawberries, tangerines, tomatoes, and watermelons. I don't know if it's just, there we go, might just be slow. Specialty crops also include vegetables, artichokes, asparagus, broccoli, cabbage, carrots, cauliflower, celery, sweet corn, cucumbers, eggplant, garlic, iceberg lettuce, romaine lettuce, dry onions, green onions, peppers, potatoes, rhubarb, spinach, squash, sweet potatoes, and taro. Nuts, including almonds, pecans, and walnuts, and then another category they call other, which is beans and mushrooms. There's also the ability, if a commodity is not included in that list, producers can request, if they provide the information, to have additional commodities included. There are payment limitations on this. The CFAP payments are subject to a per person and legal entity payment limitation of $250,000 for all eligible commodities. So if a producer is eligible for, let's say, corn and soybeans and cattle, it would be $250,000 across all 3 of those commodities. There are special payment limitations that apply to participants that are corporations, limited liability companies, and limited partnerships. And they can receive up to $750,000 based on the number of shareholders with a maximum of 3. Each shareholder must contribute at least 400 hours of active person management and or personal active labor. The application form, and there is a payment calculator for producers, is available at farmers.gov/CFAP. It's a very good website. If you haven't been on there, there is a ton of information there. FSA has done a really good job putting that together. There's also a call center, 877-508-8364. I've talked to a couple of people that are on that call center, and they are swamped and inundated with calls. So people have to be very careful about how long this is going to take. You have to be very patient. And at this time, the USDA service centers are available only for phone appointments. They are not available for in-person appointments. Some local county offices are requiring producers to actually do a phone appointment, and others are not. So you need to contact your county office. The applications can be mailed, faxed, hand-delivered, or submitted electronically. There's additional forms required, as you can see there. But if you're an existing customer of FSA, the information is likely already on file, or you may just have to update some of that information. Currently, as of June 8th, if you go back one slide for me there, John, I assume you're controlling the screen. As of June 8th, for Missouri, over $43 million has been paid out to 9,738 applications for Missouri alone, and for the U.S., a total of $1.4 billion has been paid out over to 80,261 producers. That information is available on that farmers.gov CFAP. They update that every Monday at 2 p.m. Eastern, 1 o'clock Central. So those numbers I just gave you are outdated already. Like I said, there's a lot of good information on that website. There's a tab on the website for each of the different groups, the different commodities. You can click on that. There's a lot of question and answer out there. I know one of the big questions a lot of people have had is what constitutes, on the crop side anyway, the non-specialty crops, what constitutes grain that is eligible, and it lines out exactly what types of contracts are eligible and what types of contracts you might have on your grain that are not eligible. So that's a really good website. You can click to the next slide, John. I'm going to spend just a little time here before I wrap up, going through a quick example. This is the payment calculator. It's an Excel spreadsheet that producers can download. They will have to enable macros for it to run. As you can see, this is the data entry tab. Over there on the left-hand side, there are some buttons to click on. And one of the nicest things about this calculator is you enter all your information here. It will calculate your payments and show you that. But also, if you look over there on the left-hand side where it says go to AD 3114, that is the actual form that a producer needs to fill out. So if they enter this information, click on go to AD 3114, the form is filled out for them. They can print it, sign it, scan it back in, and they can email it to their county office, and they've got their application in. Quick example I've got here for you. Corn, you can see down there towards the bottom. For this farm, I just said that the farm had 200,000 bushels of total production of corn in 2019. And as of January 15th, they still had 150,000 bushels not sold. So how this works is you take 50% of total production, or 100,000, and you look at the production not sold as of January 15th, and the lesser of those two is what you're going to get paid on. You're going to get paid on 50% of that. So in this case, 50% of the 2019 production is 100,000. They've got 150,000 unsold. So they're going to get payment on half of that 100,000. So they're going to get payment on 50,000 bushels. It does the calculation for you. There's two different payments that make up the total payment for corn. There's a CARES gross payment. You can see for this example, it's also showing you only 80% of what that total payment would be. So for this example, on the 50,000 bushels, that's $12,800. The CCC gross payment is $14,000. So there would be a total payment for this producer of $26,800. That's 80%. At a later date, they could receive another $6,700. So once they enter this for all their different commodities, and you can see there at the top is dairy, and then was non-specialty. Below that's going to be livestock. You're going to have specialty crops below that as well as wool. You can print this. Again, like I said, print it out, sign it, scan it back in, send it in, and you've got your application submitted. That's what I've got, John. So I'll hand it back to you.
Appreciate that. So we're going to jump on into some of the broader summary slides now, and I just wanted to. There wasn't a super huge change in the WASDE that came out earlier. And one of the things I just wanted to make a couple of points about, if you go through there and you look at year-over-year change, that's the column on the far right. You can see that really some of the big changes that we're expecting from last year, one is on the ethanol side, we're expecting a recovery in ethanol demand. And so as motor gasoline use picks back up, and certainly as they reset the blend rate, not the reset option, but as they every year they set the blend rate to attain the volume obligation. And as they do that for 2021, that also should capture any anticipated decline that the Department of Energy is forecasting for ethanol, and that will give us back, in theory, a pretty significant increase in ethanol demand. And you can also see the feed and residual use there at 350 million bushels higher. Some of that is related to, of course, the crop size that is being projected for 2020. Usually when you get large crops, you also see the feed and residual, especially the residual portion of that number, increase. On the other big difference from last year is going to be an increase in soybean oil consumption, particularly for biodiesel. Couple of things going on there. One is, of course, there's been less used vegetable oil available for the biodiesel industry, in part because of the change in full service restaurants, not with the closure of those due to COVID-19. There's been less used vegetable oil or used cooking oil available, and so some of that has translated back over into more soybean oil demand. The other part of it is that soybean oil prices haven't been, or have kind of eased a little bit. So when you have lower prices, plus you have kind of a more abundant supply of soybean oil relative to used vegetable oil, that gives you a little bit of a boost. Plus we are actually anticipating, with some of the volume obligations that have been set, a bit of an increase in biodiesel demand. On the food use side, you see also an increase of 300 million pounds. There's, as I've talked to some other folks in the industry, some of them scratching their head a little bit about that number, not quite sure where that's coming from. And so that might be one thing to watch for in case where we might have some risk of a little bit lower demand. If I go ahead to the next screen on exports, first of all, just kind of looking at the change year over year, looking from 2019 to 2020. One of the big things there, notice that corn export number of 375 million bushels. A lot of this has to happen, is happening because we have a fairly low price projected. USDA projecting 320 a bushel for the marketing year 2020-2021. And as a result, that should stimulate some international demand. We've had, though, a lot of competition the last few years from Brazil and Ukraine in those international markets. And it showed up this year. You can see that 1.77 billion bushels that we sent out, much lower than what we have sometimes in the past, over the past several years. If we look back, that 2.1 billion bushels was something that we like to look forward to. Notice also the recovery in soybeans. Again, this is a 400 million bushel increase over last year. Some things are going to have to change to make that happen, and part of that's going to have to be, we're going to be watching China's purchases as they go through August, September, October, some of their heaviest buying periods. A lot of the grain doesn't necessarily move until, October, November, December, but that is going to be the clear signal as to whether or not we're going to hit that number. This year, it looked like we were ramping up, and then it just sort of flattened off. So if we haven't made those sales by January or February, chances are they're not going to come. Because at that point, the South American crop becomes available. So the couple of cautions on the export side, the other one I worry about a little bit is cotton. A lot of that depends upon how quickly consumer demand recovers and whether those textile and fabric mills will get going again. So that's one to kind of keep an eye on if you produce any cotton. On the production side, you can see the huge increase in corn. That one really sticks out on the year-over-year increases. 2.4 billion bushels more is what they're expecting. A lot of people telling me very, very good crops that they're seeing as they drive across Illinois and Iowa. One of the things that I have heard from farmers in Missouri is concern over the amount of land that's had to be replanted. Some of it went in early and got caught kind of in some cold weather. Some of it got flooded again. I had one producer tell me that he was replanting for the third time on some of the land that he had planted to corn. So there are some spots that it's been very difficult, especially with some of the rain patterns that we've had in certain parts of the state. With that, I'm going to move on to the price summary. Not a lot of change in outlook from, if you look down this on the crop side, really no change in prices from last month, but you can see year over year some pretty significant declines. And so that'll be interesting to see what we come out with at the end of the day. But right now, that's the prices that we see in the projections are kind of dismal. And so these are things that folks are very focused on in terms of trying to see what kind of support we can get. And certainly the PLC program looks like it is very attractive right now, given where these prices have moved relative to the reference prices. And so it's probably a better chance now, given what we know, that PLC is going to pay versus ARC. So with that, I'm going to turn it to Marty and for the World Corn Supply and Use. And Marty, I'm going to give you remote control, or we'll try to give you that.
Hey, thanks, John. Well, we're going to start out and just to cover a little bit more on the world side here for the corn supply demand. I guess the main thing that strikes me on this table is the production. John covered it a little bit there, but we've got world production increasing. Mostly is that increase year over year. So the change from 2019 to 2020 there in that right-hand column. So we've got global production increasing by 75 million tons, and 60 million of that, though, is the U.S. So the big increase here in the U.S. crop forecast is what's the big driver there. Of course, our production increases projected for, Brazil. Of course, that would be a year from now, production a year from now in Brazil, but also increases for Ukraine, Mexico, Canada. But of course, the U.S. is the big driver there. The other thing to point out, I think, on this table is the change in stocks from a year ago. So we've got ending stocks there that number in the bottom right, increasing 25 million tons. So that's also U.S. U.S. stocks in terms of million tons is projected to increase, I think, 31 million tons. So actually a slight reduction in the foreign stocks relative to the U.S. So big stocks increase here in the U.S., driving the world numbers. I guess the good news is that we are seeing a stocks build here. That's responsible for a lot of the change in the global numbers. If you look at foreign stocks to use, relatively flat, especially if you exclude China from those numbers. So it doesn't look quite as bad as maybe some of these numbers suggest with the foreign stocks. Actually, stocks to use wise, relatively flat. Trying to change it, but it doesn't want to move. Okay, so I mentioned on the supply demand, there really weren't many changes from last month on the supply demand. One thing for the old crop is that USDA resurveyed, recontacted the folks in North Dakota, and they wound up cutting harvested acreage for North Dakota by 100,000 acres and lowered North Dakota's yield by 10 bushels. And that lowered the national yield by 0.4 bushels per acre. So we went from 167.8 down to 167.4 for a total reduction in the crop from last year now. If we're finally getting dialed in on what last year's crop was, revised it down 45 million bushels. That was mostly offset on the demand side by USDA lowering the use for ethanol by 50 million bushels. So we netted out ending stocks there on that 2019-20 column there at 2103. So a marginal increase in ending stocks from May. And then you move over to that 2021 column. So beginning stocks now at 2.1 billion, up just fractionally from last month. Really no other changes in terms of the production and the use. So we just had a very slight increase. That just fell through the balance sheet. And so we wind up with the ending stocks up slightly from last month, up 5 million bushels also. However, you note that big year-over-year change though in ending stocks. So we go from 2.1 billion carryover this year up to something close to 3.3 billion in 2021. So a pretty hefty increase in the stocks, and therefore you've got season average price down 40 cents from this year at 320. Got the planted acreage. I put this in here because at the end of the month, here on June 30th, we'll get USDA's acreage estimates. And, the March intentions came in at 97 million for corn. Most believe that number will come down. I haven't seen the trade averages yet, but I suspect that the trade is probably more like 94 to 95 million on this figure. Some a little lower than that, maybe some a little higher, but I suspect something in that 94, 95 million range is probably kind of baked into the market at this point. I'd say, if it does come in at 93 or less, it'll probably be a little bit friendly for prices. Something over 95 is probably a little bit negative for prices. Anyway, we'll see where that shakes out. We did have some late planting, particularly again in North Dakota. So farmers up there are trying to harvest the 19 crop and then struggling to get the 2020 crop planted. So probably will turn on how many acres or wind up in prevent planting in northern or North Dakota and some of those northern plains states. Next slide. Want to mention the ethanol. Had this slide in last time, but you can see the black line there is the weekly ethanol production. So we're reading that on the left-hand axis there in millions of gallons. So for the last 6 weeks now, we've seen the ethanol production rebound pretty nicely. and the red line, which is the stocks numbers, come down. So we've had a bit of a recovery. Essentially we've climbed back and regained about half of what we lost there on that big decline through March and April into May. So a pretty decent recovery. USDA's numbers, that revised number at 4.9 billion. If we're going to achieve that, we probably need to see that black line there move up to a weekly rate fairly close to that 300 million per week mark. That'd be down, I think, 6-7% from a year ago. So we might be able to get there, but it looks like a little bit of a stretch. So I think that there's probably still some risk that the ethanol number could still come down. We'll see how it behaves here over the remainder of the marketing year. But I'd say some risk of another 50, 100 million could come out of the corn for ethanol. The next slide is corn condition rating. So it's early in the season, but we have started getting the condition ratings for corn. This is looking at percent good and excellent combined. So as of last Sunday, crop was rated 75% good to excellent. Now we'll get another update here this afternoon shortly on this statistic. Trade, I think, is expecting something fairly close to where it came in last week, maybe slightly better or down a point or so, but not a lot of change. You can see that's well above the current rating at 75%. It's well above the 10-year average, that red dotted line. So, and you can see seasonally, you tend to have the condition ratings decline a little bit through the summer. So it wouldn't be too shocking, even to see these ratings come down a little bit, because that would just essentially track the seasonal ratings. You can see also there the 2019 crop rating, the initial rating with the late planting last year came in a week or so from now. So, and that was 59%. Good to excellent. So we're well above the 10-year average, and certainly well above a year ago. Point being here too is that with these fairly high ratings, the trade is thinking that the ones USDA's got 178 bushels, 778.5 bushels plugged in for the national average yield. So you look at the crop rating and start thinking that maybe the yield could be higher than that. And some are even talking all the way up, already talking about something in the low 180s for national average yield. So we'll, keep an eye on that. These crop ratings tend to be a lot more predictive of final yields as we move a little further into the summer. Once you get towards more like late July, early August, ratings at this point in the season are still pretty loose compared to the final yield. Okay, let's, the next slide, I just wanted to look at soil moisture. You can see where we've got soil moisture anomaly as of June 12th, and you can see a lot of green and light green on there, which suggests plenty of soil moisture around. You got a few dry pockets out there towards the west, maybe southwest Iowa into eastern Nebraska, but generally a pretty good soil moisture profile. The forecast over the next couple of weeks kind of leans in that northwest part of the Corn Belt, the Dakotas, Minnesota, is a little cool and dry. The other 2/3 of the Corn Belt leans a little more warm and wet. So there's nothing really in the forecast, at least for the next couple of weeks, that suggests much of a threat to the crop at this point. So far, so good. Not much on the weather front at this point to spark a rally in prices. I wanted to once again show the commitment of traders. And we're seeing a pretty big fund net short position here accumulating as prices have kind of eased, through the spring. We've seen the funds add to their net short position. They're up to nearly 300,000 net short corn, that blue area that you see on the graph. You see back a year ago in the spring, they got to a record 322,000 net short. And then we had the wet spring and planting delays, and it was a little bit of a, I guess, delay in terms of the market responding to it. But once it did, the funds came out of those short positions and moved to a net long. So we've moved from minus 320,000 contracts to almost 200,000 net long, and that that moved prices up almost $1 a bushel on that, or at least followed along with that change in price. This doesn't mean that we're going to see a $1 rally in the corn market, but what it does suggest is prices are vulnerable, to a short covering type rally at least. But what we're lacking at this point is some kind of a trigger for that rally. So we don't have, kind of the weather, we don't have the heat dome or the dry, extended dry forecast that could kind of trip this and begin to push the funds to kind of unwind this short position and buy it back. So anyway, I point this out is this is kind of a wild card. If we were to see something come along fundamentally that would start to push the funds to unwind, this could be a bullish element to the corn market, at least for a short period of time. Next slide. This is the monthly continuation for corn. So each of those bars on there is a month's worth of trade. This goes back all the way, to 2005. So you can see here that the last few years, corn prices have really been kind of in a trading range between about $3 and $4.50. Markets down toward the lower end of that range. We have support on this chart, which is being kind of tested right around $3.15 and then down towards $3 even. So that $3 area is going to be pretty important, I think, from a technical point of view for market to hold longer term. If that support gives way, it could signal some downside follow through fairly quickly, at least from a technical point of view. The next slide, we've got the December futures contract. You can see since last month, and we were discussing the WASDE, prices have edged up a little bit, up 10, 12 cents or so from where we were last month. Typically this sort of May, June is a little bit of a friendly time for prices, and we have seen the market move up a little bit, but fallen short, I would say, of its normal seasonal type strength. We have these retracements on here. So a retracement of that whole down move from back early this year to the low in April down at 325, about a 38% correction of that down move would take it up to 355. 50% would take it up to 365. So I think something up in that range is probably about all we could expect, if we can get that. Seasonally, we're moving into a point in time where the seasonal starts to turn from friendly to negative. So once you get into late June, early part of July, the price seasonal for the new crop tends to turn pretty decisively negative. So it'll of course hinge a lot on weather, but I think the market becomes more vulnerable at that point. You can see here the December futures trading in the low 340s. I mentioned the $3 area. So without a weather problem, you see this carry out there to the December futures kind of ease a bit, and then we get towards late summer, and perhaps the December corn is testing that $3 support area long term. This just kind of summarizes things. We've got above average crop condition ratings, which is a little negative for prices, a favorable soil moisture level. So that gives us some support to the crop, even if we do hit a dry patch here for a while. We've got a pretty large increase in U.S. and global stocks, driven mostly by the U.S. The price seasonal will turn negative here in a matter of a couple of weeks, so we need to keep an eye on that. This next couple of weeks should be fairly critical in terms of maybe marketing the remainder of the old crop and some getting some new crop sold. And then I think that long-term support there at $3 to $3.15 is pretty significant. And then the acreage report, the next big market movers from USDA be the acreage report on June 30th. along with the grain stocks report. So the grain stocks will be stocks as of June 1. And this will give us another look at what the pace of corn feeding is at that point. So the June 30th reports could be market movers. Still be watching for that. That wraps up the corn, and hand it back off to John and soybeans.
Okay, thanks, Marty. Appreciate that. The on the soybean side, I guess first thing is not a lot of earth-shattering news from last month in terms of changes. We did get to see the 2019-20 crush revised up about 15 million bushels. Production was revised down 5 million bushels. And then, but we lost 25 million bushels in exports. So that more than offset really all of the good news we sort of got from the demand side and a little less supply. So that left us with a little bit more carryover stock, about 5 million bushels that fed into 2021. And then we did see a little bit of an increase in crush. So overall, we netted out with ending stocks revised just slightly higher in total. And so when we no real significant change in prices or really nothing this month in terms of revisions from last month, but still projecting a 820 price for 2021 for soybeans. One of the things been watching here a little bit with soybeans here, there's been a lot in the news about soybean export sales picking up over the last month. I wanted to give you a little bit of perspective. You can still see that we're, well below last year's levels at this time, at least as of the 4th of June. We have not yet seen, even though they're talking a lot about it, we haven't yet seen the pickup that we might like to in terms of exports, and especially under the anticipated U.S.-China trade agreement. So much, now we're starting to focus on next year, 2021, and see, are we going to come in with sales? If we enter the marketing year on the 1st of September with sales closer to this, 500-600 million bushels, we'll be a whole lot more excited that maybe we'll see some real pickup in our soybean exports. So it's going to be one that we're going to keep an eye on. If you want to look at year to date to China, again, we're starting to see a little bit of increase in terms of total sales for this marketing year to China. And it's kind of unusual at this time of year for us to see a whole lot of action, simply because they're purchasing most of what they need from South America. But we have seen some recent sales. It's not completely flat, so that at least is positive, but it's perhaps not of the magnitudes that we'd like to see. As we look at a worldwide basis, what changed from last month? Not really a lot. We've got slight reduction in production in the U.S. overall in the world. We've got a little bit of a decline in overall soybean production, but again, not much change from last month. If you look at year-over-year changes, though, of course, we've got a big increase in the U.S., and that's coming from a lot of recovery in soybean area planted this year. And then you can see also that Argentina and Brazil are also contributing year-over-year to the increase, or are anticipated to contribute to the year-over-year increase. If you look at soybean supply and use on a worldwide basis, again, not a big change here. One of the things that we are kind of keeping an eye on is what's going on with Argentina and Brazil. How much more, how much are they going to be able to export? They're part of the reason why our exports for soybeans are down this month the exports were revised out of the U.S. this month, down 25 million bushels because of their competition. Part of it has been also a very weak Brazilian real. Their currency has really depreciated against the dollar, and so it's been tough sometimes to compete when you have that happening. as we look out then, here's the nearby futures. I just wanted to give you a sense for, what's a good price to sell at? Where should we be at? Normally, we say if we're going to get in the top quarter of prices, we should have sold at 934. If you didn't sell, what can we expect? If we're still carrying old crop at this point, if it's actually, anything in that $8.80 to $9 range would be a really good price right now. Watching that on futures, of course, you'll have to adjust for your local basis, but it's certainly, I do know on the river ports, Mississippi river ports, the basis has been actually very, very strong recently. In fact, almost even, with normally runs 20, 30 cents under. I've seen it be even zero here in the last few weeks. So something that you may want to keep an eye on if you're still carrying some of that old crop, look and see if there's some opportunities. May not be a bad opportunity to market it. You certainly don't want to be holding it after the 1st of July if you can avoid that, because typically we do get market almost always moves down after that point in time, unless you're gambling on a drought and know something the rest of us don't. If we look at then the November soybean futures, again, if you have not priced any of the 2020 crop, and depending on your cost of production, where you land, there may be some pricing opportunities here in the next week or two. Keep an eye on the market sharply. Really, anything above the $8.90, $9 mark is probably going to be a very good price at this particular point in time. Anything else, you're gambling probably a little bit on whether or not there's going to be a drought. With that, I'm going to turn it over to Wesley for the livestock outlook.
Okay, thanks, John. Scott just popped on here. I was waiting to see if he was going to want to do it. See if I can advance the slides here. Can you give me control, John? All right, now I think I've got control. Nope, still not.
Okay, let me see if I can move them for you.
Okay. All right. Thanks, John. So yeah, if we think about this month's report compared to last month, if we look at our changes for 2020, we have increases in both beef and pork production, which largely is based on our faster than anticipated recovery in the pace of slaughter. The slaughter plants have come back online quicker than USDA thought they were going to, so they've increased the production quite a bit for 2020. Broiler production is also raised while turkey production is lowered. If we look at our changes for 2021, the total meat production is raised from last month. Basically, as we shifted some of that production from 2020 to 2021, beef production is forecast to be raised on higher expected placements for the second half of the year. We've held a lot of those cattle back, looking at those record low placements in March and April. So we're going to have higher placements in the latter half of the year, which will then be marketed in the first half of 2021. So that's kind of, why some of the increase in beef production in 2021. Pork production is really unchanged, as well as broiler production. There's not a lot of change on the export and imports side of things. The beef imports are raised for 2020 as we see a higher demand for processing grade beef. So, if you think about it, as prices are better here in the United States, but also think about this backlog of cattle that we're backing up and are becoming overly finished. So there's more and more trim. So a lot of people are kind of talking about this of should we be blocking imports, but we actually need those imports of those lower quality beef to be ground with that trim that we cut off of those over-processed animals to make the hamburger that we sell throughout the United States. Pork exports are also raised for 2020 based on the current pace that's doing really well. And there really weren't a lot of changes for the export forecast for any of the meats for 2021. John, if you'll advance the slide. This is probably the slide that I'm going to camp out on just a little bit. The red line is for each of the meats, for the beef, pork, and chicken, is the change in production from the previous year. For the red line bar is Q1, the blue bar is Q2, and that green bar is the second half of 2020, so the remaining 2 quarters of the year. So if you look at for each of the 3 meats, we really ramped up production as slaughter plants were trying to push as much as they could through, because they knew the coronavirus was spreading into the Midwest from the coast. So our Q1 was up for all of the meats. We all know that the blue bar is down considerably from the previous year because of what we encountered with the packing plants having to shut down and spacing workers out and the slower chain speeds and all of that. But the real question has been what is going to happen in the latter half of the year. So if you think back to last month's report, that green bar was still substantially lower than last year. Well, USDA has changed that quite a bit in the last month, and we've raised that so that it doesn't look nearly as much down from last year as before. But if we think about that, even though they've changed it, if we think about the added weight that we're gaining on these overfinished cattle and hogs, you know, slaughter weights are increasing so substantially. If packing plants can stay anywhere close to capacity at all, is that really going to be down below year-ago levels? And so that's one of the big questions that we have of, is that second half of the year going to stay that low? It's a good chance that number is going to continue to increase and will probably end up being above year-ago levels by the time we get to the end of the year. Next slide, John. If we look about what those changes that we've talked about, of how they affect price, you know, so cattle prices are raised for both 2020 and 2021 from last month's forecast based on the increased packer demand that we've seen, the run up in wholesale prices, and packers have been trying to hold those prices a little bit better. As we're going to talk about just here in a minute, as wholesale prices continue to go down, will we be able to hold those prices where they're currently forecast at is a good question. But they have raised the price for fed steer significantly for 2020 as well as 2021. The 2020 hog price, however, is actually reduced based primarily on that current price weakness and increased supply pressure that we're seeing in the hog market. If you go to the next slide, John. This is the other slide that I kind of want to hit on just to talk about how this year has really rocked our world. If you go back to when we first started forecasting both the fed steer and the hog prices for 2020 back to May of last year, you know, we were really thinking that 2020 was going to be our year. We were forecasting 121 for an annual price for cattle and 60 for hogs. I mean, this was really looking like this was going to be our year based on the cattle had plateaued and we'd started reducing some numbers. You know, ASF in China had decimated their hog supply, and so we were going to be exporting tremendous amounts of pork at excellent prices. And to just think about in the last 6 months how this has dropped, that we went from 121 and 60 down to the current levels. The only good news, as I said, is that fed steer price you do see has increased substantially since last month, whether it will continue to go that way or not. If you go to the next slide, John. This is just basically breaking that annual price down into the quarters. And so you can see kind of what they're looking at in Q3 and 4 for 2020 and then the first quarter of 2021. John, let's go ahead for time. Just slide on to the next one. So this is the WASDE forecast for price for milk. Again, going back to where we were looking, you know, when we first started this forecast a year ago, last May, this was going to be a fairly good year for dairy as well. Now, the good news is if you look at the change since last month, you know, the markets have been really strong for dairy products in recent weeks. So that annual milk price has been raised significantly since last month. The question is, can we really continue to sustain that price strength without some kind of reduction in cow numbers is the real question. We may have that price increase just a little bit overdone. Let's hope it can stay there, but I'm not going to be surprised if it doesn't present some weakness in the last half of the year. Next slide. Again, this is just taking that annual price and breaking it down into the quarterly projections. And as you can see, looking at where we're currently at and then projecting on into the first quarter of next year. Next slide, John. This is the 6-day moving average of our daily slaughter numbers to give you an idea of where the packing plants are on current capacity for cattle. This is cattle, and the next slide will be hogs. If you look at that tremendous V shape as we there through April just continued to drop and continued to drop. Thankfully, that V was a pretty predominant V and came back up. We're now back to just a little bit below the last couple of years of slaughter numbers on daily slaughter. But the issue that I want to continue to remind you is don't let this slide, because you see that we're back up almost to full capacity, think that we're out of the woods, because this is such an unprecedented situation that we find ourselves in, especially for the cattle markets, that we have just backlogged so many of those animals that, yes, we broke through 650,000 head last week, but we need to get back to above full capacity to even begin to start working off those numbers. So the question becomes, how hard can we continue to push these plants? We're currently running Saturday shifts, very, very heavy. Can we move to a Sunday shift as well? Workers need some time off, and they need some time to rest and recuperate. How hard can we push these plants to work through this backlog is a really big question. And of course, if anything was to happen that we were to have to space those workers out and shut plants down again, then this would really become ugly. But this is something that's going to stay with us not only through the remainder of this year, but probably into early 2021 before we can begin to get completely through this backlog of cattle and stop this from weighing on the market. If you go to the next slide, John, this is the hog market, or the hog slaughter numbers, I'm sorry. And as you can see, it beat and got right back up there too as well. But again, we still have significant numbers back there that we need to work through. Next slide, John. If you think about our wholesale prices, this one's beef and for the different cuts, and then the next one's going to be hogs, just to think about the tremendous run up in prices as the plants had to shut down, what that did to our wholesale prices and then transfer over into our retail prices at the supermarket. I mean, that's why everyone was scrambling and saying, well, we've got a shortage of meat. Well, we didn't have a shortage of animals, that's for sure, because we show how many we've backlogged, but we did have a shortage of meat moving through the supply chain out to our consumers. The interesting thing is if you look at beef, they were all of our the normal cuts were pretty consistent in their run up, and now they're pretty consistently dropping pretty hard. But if you go to the next slide, it's kind of an interesting change in pork, that as we move from that whole food service to people buying their groceries at home and preparing them at home, then we had different shifts in products. And just look at the belly price, that purple line of how significantly that belly price ran up and then how significantly it dropped right back off that cliff. And so we've had some price shifts as we move more from food service to eating at home. And it's going to be interesting to see as we go back to opening things back up and as open the country back up, and if people go back to eating out like they were before, you think about, we were eating so much more of our food dollar was eating out versus eating at home. It's going to be interesting to see how those trends stay or change. They say it takes 30 days to induce a habit. So are we going to continue to eat more at home or go back to our food service and having someone else prepare our food for us? If you go to the last slide, John, just remember, if we think about where we have come, as I said, in the last 6 months, and where we were thinking hogs were going to be 60 cents a pound and really doing well, but just be glad. Well, I guess I shouldn't say glad, but if it had not been for ASF in China decimating their hog herd, because we talk about, all the trade disputes and stuff with China, but if we were not sending, this is our weekly pork shipments to China, and if you just look at that bottom bar, that kind of teal bar was where we had been traditionally, and then in 2019, that yellow bar, we started climbing. If we were not sending this much pork to China, pork producers would really be in a world of trouble if we were having to eat all of that domestically. So thankfully, we do We do have our export markets to look forward to. Hopefully that is going to help us significantly as we try to work off this backload of all this animals that we've backlogged in the system. John, I'll turn it back to you.
Okay, well, I'm hoping that we have some questions